Okay, so excellent. Keep on putting them in. That's exciting to see. Thanks for joining us, everyone, as I mentioned. So my name is Christina Rezzi. I'm Director of Continuing Education at Advocis. Thanks so much for joining us. Don't worry about putting your Advocis ID into the chat. We should be able to find you. Just make sure that you've logged in with your correct name so that we can match that up to our registration records. Your CE will be uploaded into your advocacy tracker within a week or so. And without any further ado, I'll pass it over to our president and CEO at Advocis, Greg Pollock. Over to you, Greg.
Great. Thanks, Christine. Hi, everyone, and welcome back. Happy to be moderating this session again today. Just very, very excited about it. As you know, it's the second of two webinars entitled The Essentials of Estate Planning, which includes information from the recently updated book, The Essential Canadian Guide to Estate Planning. Today, our co-presenters will discuss the estate planning needs of business owners with a case study involving a family-owned business. Topics will include the estate planning process, family dynamics, and essential tools such as buy-sell agreements, family trusts, and corporate-owned life insurance. This session will also discuss buy-sell arrangements involving arm's length shareholders. Returning from last week's webinar is the author of the book, Kevin Wark, who is KLU's tax advisor and also managing partner of Integrated Estate Solutions. And also presenting today is Glenn Stevens, who has his own tax and estate planning consultancy firm. And many of you would know that Glenn retired recently as VP of Planning Services at PPI Advisory. Today's session qualifies for 2 CE credits to ensure that you've logged into the Zoom and there with your actual name, so that an email address, so that we can ensure you get the appropriate credit. That has your member profile, of course, as well. The plan is to go for approximately 2 hours with a 5-minute break in the middle. This will leave about 15 to 20 minutes for questions at the end. You can use the chat button at the bottom of your screen to ask your questions, and feel free to direct it to one or both speakers. So now I will turn it over to Glenn to start things off. Glenn.
Well, thank you, Greg, and hello again, everybody. It's great to be back again with all of you, and with Kevin on the panel again for the umpteenth time over the years. Just a quick recap of webinar 1. That was an estate planning case study for a high net worth couple, not a business couple. We talked about the estate planning process and how that all works in terms of gathering facts, hard and soft facts, working with other professionals, identifying issues, goals, and objectives, providing options for review by stakeholders, implementation and review cycles. We talked about estate planning being a process, not an event for sure. It takes time to put these cases together. Now, webinar 2 is going to be similar. The process is pretty much the same, but the focus is on multi-generational business estate planning. So we're focusing today on family business. There will be some material at the end that Kevin's going to cover on arm's length businesses and buy-sell options, but our primary focus today is on family business. We'll talk about the differences in estate planning for business owners versus non-business owners. And obviously, life insurance opportunities is going to be a significant part of the discussion as we go through. Again, this is similar to what we said to you last week. We're talking about income tax today, which is a federal law. We're also talking primarily Kevin, but both of us will be talking about the budget from 2 days ago, which is going to change some of the income tax rules as it applies to family business. Those are federal. Quebec has its own set of rules, as you would all know. If we get into discussions of things like matrimonial law and succession law, that's all governed by the provinces. And I'll be dealing with a couple of court cases, for example, that are provincial level cases that are based upon provincial law. So there will be, we'll try to highlight those things as we go through. Kevin and I have spent our careers in Ontario, so that's the jurisdiction we know best. But there will be some other provinces referred to, and we will identify and do what we can with those other provinces as well. And of course, goes without saying, and it's a major part of this whole strategy or estate planning process, consult with accounting, tax, and legal professionals to make sure of the impact of the income tax and provincial law relating to a client's situation. These are your teammates, the accounting, tax, and legal people that work for your clients. And obviously they should be intimately involved in whatever planning that you're engaged in. Okay, so I want to refer now to a recent study by the Canadian Federation of Independent Business that came out in January. It's called the Succession Tsunami. Kevin claimed this was taken by my wife on vacation, and I'm actually surfing under that wave. That is not true. I don't know how to surf and would never try that, although it looks like it might be fun. This was the tsunami that they're referring to is the upcoming transfer of trillions of dollars worth of small business in the upcoming years. And here are some of the highlights of the report. I think these percentages, you can take them with a grain of salt. It's hard to know how precise they are, but here's some of the findings from this report. 76% of Canada's business owners plan to exit the business within 10 years. Estimated asset value, $2 trillion. Now, I've met a lot of business owners who say they're going to leave within 5 to 10 years. I think that's always, you often hear that from business owners. I don't know if this is reflecting a higher than normal number of business owners that have that in mind, but that's the figure, 76%. Only 9% have formal business succession plan in place. That's a wow number, and that's a small number. And that creates opportunities for this audience because most of your clients don't have a formal business succession plan, and you're one of the key players that can help them develop one. Finding a suitable buyer is the most common obstacle to successful transition. The most common purchasers you'll see there, unrelated parties, almost half, family members, 24%, and that would include purchasers and perhaps children that are inheriting businesses as gifts from their parents. And employees, 23%, almost the same number as family members.
Yeah, the only thing I guess I would comment on in this slide is if you look at the Canadian demographics with the boomers, it's not surprising that a lot of business owners are contemplating retirement and exiting the business. As Glenn said, it's not clear whether 76% is the right number or not, but there's a large number of people that are looking at retiring and transitioning the business right now.
Yeah, I agree, Kevin. I think demographics is driving a lot of this. The baby boomers are really getting up there in age now, and I should know. And so there is there's a lot of activity based upon demographics. Essential factors in considering the sale of the business. These are identified by the business owners who did the poll or did the survey. Protecting current employees was the #1 factor, which is interesting and nice to see. Getting the highest possible price, selecting a buyer with compatible way of doing business or continuing the business's legacy. I see that as kind of synonymous, but people that have built a business, they want to see it continue, but they like to see its legacy continue as well. And ensuring that the business remains in the community. Of course, a small business typically has significant ties to the community that they're in, and they want the business to stay there if they're selling it.
And we'll talk further about soft facts, but this is clearly a soft fact area where you need to ask those open-ended questions and find out what are the goals and objectives of your client with the business, and from there, that will sort of guide a lot of the solutions that you put forward for them to consider.
Yeah, that's right, Kevin. So here's an interesting and maybe a concerning statistic or series of percentages. Who do business owners look to for advice on business succession? Which professional do they look to? Well, accountants are at the top of the list, 43%. I'm not really surprised to see that because of all the professionals, accountants are the ones most involved typically in the day-to-day workings of the business. So I'm not surprised to see accountants at the top of the list. Lawyers are next, and I guess that's not too surprising either. Then we get into key managers. That would be internal managers, I would think, financial advisors, financial institutions such as banks, 4%, and finally, insurance brokers at 1%. So that's, to me, a bit eye-opening as well. Certainly, Kevin and I have worked with many insurance advisors who are key trusted advisors to business owners and who are intimately involved in succession planning with them. However, it seems as a general rule, business owners do not see their insurance advisors as a key source of advice on succession planning. So hopefully what we're going to do today will help all of you improve that 1% number to something much higher, which is where it should be.
I think it could be that many of the advisors they deal with have an insurance license, but have positioned themselves as a financial advisor. So there are probably a number of people that fit in that category. And I guess the other comment is working together with the client's other professional advisors will clearly position you to be operating in this market. So if you've got relationships with lawyers and accountants, you've got over almost 75% of the people that advise business owners that can help you position yourself.
That's right. And again, it's hard to know how accurate these percentages are. I'm surprised to see that 1% number, and I think the real number is higher. But as Kevin says, this is a team effort. You're not going to be the only one providing succession planning advice, but neither should the accountant and the lawyer be the only one providing it. So working together is the key. So here's the conclusion of the report. With over 2 trillion in assets set to change hands within the next 10 years, and only a fraction of business owners having a formal succession plan, the risks associated with improper planning are undeniable, and that's certainly true. And this group is in a very strong situation to deal with those risks. Obviously, that's what you do every day, is deal with risk planning. And so it's a great opportunity. The fact that so few business owners have really got their act together is a great opportunity for those of you that want to get involved in this area.
Yeah, and if you combine these statistics with the Angus Reid poll that we talked about in the first webinar, where less than 50% of people have wills, you put that together and you've got a great problem and a great opportunity. So that's sort of good, the good news and the bad news.
That's right. That's right. So this is a reminder from the first webinar: why engage in the estate planning journey at all as an insurance advisor? Why would you do that? Well, there's many good reasons. Developing a deeper relationship with clients. This a big part of this whole project, if you want to call it that, this whole point of view that Kevin and I are taking, is that you want to get it by getting a deeper relationship with your client. You're becoming a trusted advisor. You're becoming a business advisor. You're no longer just an insurance provider. You're someone that's providing a person that's providing something more to your clients. And through them, you get access to new clients, family members, relatives, and friends. You get access to other professionals, because working in this market, by definition, really means you have to work with other professionals. And the better job you do, the more referable you are by them as well. I know, as does Kevin, many insurance advisors whose main source of business is referrals from other professionals. It's a great place to be. And finally, being part of this process, you're building your own technical expertise to support the positioning of products and services to meet the client's needs. Again, you're not selling a commodity, you're providing a product and a service that will help the clients achieve their objectives, rather than just selling them insurance. So those are all, I think, strong reasons why the estate planning journey is worth it for those of you that are interested. So now we're going to get on with our family business case study. And we'll give you it's the same drill as the last webinar in terms of the process. It's not a whole lot different, although the treatment of some of these bullet points is quite different in a family business setting. Gathering the hard facts. Again, Kevin's fact finder, you see the reference there to his website with the fact finder. That's a great way to collect hard data, collect information. You need to do that. Gathering the soft facts, Kevin's already referred to that earlier, and it's absolutely true, especially in a family setting. The soft facts are every bit as important. And I think I said this last time, the hard facts, we can look at the hard facts, and a lawyer or an accountant or an insurance person could come up with a solution based upon the hard facts. But if the clients aren't prepared to make that solution work, that's where the soft facts come in. the solution will never happen. And so the soft facts are incredibly important in this process. Having gathered as much information as you can, you're going to identify the priorities, issues, and concerns of your client. You're going to identify options with the support of other advisors. You're not sitting in a separate room doing your own plan for the client. You're going to work hopefully with the other advisors and come up with a solution together that makes sense for the client. You're going to review those options with the client and the family and review next steps. You're going to be involved in implementation. Implementation will involve inevitably legal documents such as maybe new wills, a shareholders agreement, whatever it might be. You would be involved perhaps in the hopefully on the insurance side, implementing new insurance programs. The accountant is going to be involved with the tax planning. Typically, everybody again working together on the implementation. And then of course regular review. Once you've gone through this process once, that's rarely the last time that you'll want to do it, because things will change. You'll need to review things regularly because there's a lot of factors that can change over the years and lead you on to another estate planning journey. Hopefully the second one will be easier than the first. You'll have a template from the first time through.
Yeah, it's, as Glenn said, very similar process, probably in most situations more complicated and complex because of the business interests that are involved, and there may be other stakeholders that aren't involved in an estate plan with high net worth family. For example, you could be dealing with other shareholders in the business if it's an arm's length situation, or employees who have a stake in the whole thing. There may be a variety of people you're trying to sort of take their views and satisfy in the process.
Not to mention other family members. So again, everything you said is right, but then you layer on top of that there would be, as you can imagine, children in the business, children not in the business. All sorts of grudges could be happening behind the scenes, with family dynamics being what they are. So it is complex, and it is hard to get to the finish line sometimes with families that aren't functional. We're hoping that our pretend clients here are functional. We certainly have some ideas that might help them. John and Mary are the clients. John is 61, Mary's 57. We're assuming that they have a strong marriage. There's no issues with them. They have 3 children. Tommy, who's 33, he's married with 2 kids. Used to work for John, but it didn't work out. And I guess we can either think that John thought that Tommy wasn't measuring up, or Tommy thought that John was too old-fashioned. Who knows? It didn't work out. And Tommy now has his own plumbing business, although the personal relationship isn't bad. Tommy's got his own business on the side now. Annette is the middle child. She's separated with 2 young children. She works in the business part-time. And Sally is 26. She's attending university, not sure about career path yet. So here we've got 3 children. We've got one with his own business. We got another one who works part-time in the family business, and a third who is not involved. This isn't unusual. It's not obvious if any of them is going to become the business successor to John and Mary. The family business is called Renco. It's a home renovation business in Ontario. It qualifies for the small business deduction. Its shares are eligible for the capital gains exemption. There are 20 employees, and there's possible purchasers amongst the employee group. Again, it's not certain. They would have to be able to buy in, and there's a long road ahead if they're going to do this. But there are 2 or 3 employees that may be interested in share ownership in the future. And Renco is profitable. It survived the pandemic and is doing well despite the difficult past 3 years. So we're assuming a strong business and growing. Its current value is $6 million. John is the sole shareholder. His shares have a nominal ACB. John still has access to $800,000 of the capital gains exemption. The exemption is in the range of $970,000 now. John has 800 of that remaining. And there's $1 million term policy on John's life, which is personally owned and which may need some tweaking by the end of this presentation. John is the CEO. Obviously, he's running the show. He's the sole shareholder. But Mary has her own abilities. She just left her accounting practice. She's now the CFO and works with John in the business. John's salary is $150,000. Then he takes dividend income as and when it's available as additional salary. Mary earns $100,000 plus bonus. A net salary is maybe a generous $70,000 for a part-time employee, but let's assume that it's a supportable amount that she's getting paid. And when her second child starts preschool, Annette plans to increase her work hours. So I think we can assume that Annette is going to become more involved in the business. We don't really know at this point whether she's going to end up owning it or not. And here's the balance sheet. I guess it's a personal balance sheet, and you can take a look. John's got Renco, the Renco shares all in his name at $6 million. He and Mary both have RSPs and TFSAs and automobiles, a nominal amount of debt, really not a material amount of debt. They've got joint investments. They've got their home and their cottage jointly owned. And you can see that the capital gain on the shares is $6 million. The other tax liability can be easily calculated, the RSPs, and the gain on whichever residence they don't use as the principal residence. So all in, they've got total assets in excess of $10 million, minimal amount of debt, and the tax liability would be based mostly upon their Renco shares and the RSPs. Those are the things that would likely contribute the most to their tax liability on the second death. So I think with that, I can turn it over to Kevin.
Thanks, Glenn. So I guess we've done a lot of the hard and soft fact finding, but there are some questions we want to ask John and Mary in terms of their future and how they see things going. And what they tell us is John is getting tired. Although the business is doing well, it's been very tough on him, and that's why Mary decided to join the business to try to relieve some of the workload and stress. But he's basically said that the next 3 to 5 years he would prefer to have rolled back his involvement in the business and pass it on. And there is a desire to consider Annette as a potential owner of the business, depending on how the next 3 to 5 years go. Tommy, as Glenn said, the relationship is sort of on a repair route. He was previously in the business. He's running a business that's got elements of the renovation business that John is running. So he's potentially a candidate, and the other daughter, it's not clear. If it does not work with the children, then clearly there are some employees that are more senior. They've got good relationships with clients and could be ideal candidates to take over in the event that it does not pass through the family. And if it does work out that one or more family members do take over the business, John and Mary want to make sure that the other child or children are treated fairly in the longer term, because the majority of the value of their estate is in the business, and if that goes to 1 or 2 children, then they need to figure out how to take care of the other children, and we've got some options for them to consider as we move on through this analysis. Some other things they've said they want to accomplish. Well, I think most people, when you ask, do they want to pay a lot of taxes on death, they say no, and Mary and John are no different. They've identified what they'd like to do in their retirement years. They haven't done much traveling, so they would like to have enough money to make sure they travel. Potentially, they've got now friends that are buying places down south. They may want to go down there and join them. They want to make sure the grandchildren's education is taken care of. And they spend a lot of time in the cottage in the summertime. They may want to sort of make that their permanent home, keep a smaller condo in town, and free up dollars to buy that place down south. So those are all things that we need to keep in mind as well as we formulate the planning. And much like the last case study, we're really going to take retirement income planning off the table. They're currently earning about $250,000, a little, depending on how the business does. Clearly, they have enough assets, including the value of their shares, to generate the retirement income they need to maintain that kind of lifestyle. So we're going to talk primarily about the pure retirement and estate planning issues. So the first one is giving them a good idea of what the potential liabilities will be on death. They said they'd like to try and minimize those taxes. So we've got the business right now that will generate a $1.3 million capital gain after taking, or $1.3 million of taxes after taking into account the capital gains exemption. That liability can be deferred until the second death, provided shares transfer to the surviving spouse or a qualifying spousal trust. One of the considerations typically when you're looking at spouse trusts for business owners is, does the surviving spouse have the business acumen and desire to run the business and be responsible, or at least have their income dependent on that business after the death of the owner. In this case, Mary does have business acumen. She will be engaged in the business, so there's really no real issue with transferring shares to her, other than whether she has a desire to continue to be involved with the business. And the other tax bill here that we need to be aware of is the RSPs, and we're assuming that the cottage would be not the principal residence at the time of their death, and the combination of that would be another $600,000 of taxes. So right now, without any planning, if they both died tomorrow, there'd be a tax bill in the range of $2 million.
Kevin, I just wanted to, before you move on, just circle back on the spousal trust question for a second. We always talk about transferring shares to a surviving spouse versus transferring them to a spouse trust. In this case, it makes sense because if John predeceases, as you've already said, Kevin, Mary's familiar with the business, could probably, she may not want to, but she would certainly have the acumen to make the right decisions around the business after John was gone. Versus a trust, and the trust, it involves its own complexities, and it's certainly the tax rollover is there, the control is there, but it's, you know, it's more of a long-term solution. It can be an expensive solution. And also from a family law perspective, if a person leaves shares of a business to their spouse, the value of those shares will be included for family law purposes. But if you leave the shares in a trust for the spouse, the value of that gift may be less. And so there's family law planning that has to go into this decision as well. So it's not always an easy decision which way to go with this.
Yeah, those are great points. And clearly, if this was a second marriage situation with children of the first marriage involved in the business, that would complicate things and may mitigate towards a spouse trust.
Correct.
But putting in other measures such as life insurance or whatever to protect that arrangement from the second wife or second husband in the situation trying to collapse the trust to get access to more value. Okay, so we're going to flip into a bit of a tax talk, because there are some concepts that we're going to employ, or solutions we're going to employ, that are dependent on various tax rules. So we want to briefly talk about some of the main rules that will apply in this situation, or could apply, so that you're aware of them as we go through some of the solutions. So the first one we've already referenced is the capital gains exemption. We've indicated John has $800,000 of exemption left. So he's used that exemption previously, had a different company perhaps that he sold, and utilized some of the exemption against the gain. The aggregate exemption, it's a lifetime exemption that's available in 2023, is $970,000 odd. It's indexed annually, so it's increasing every year. And unlike some other exemptions and credits, it's available to all family members. So there's planning that can be done that we're going to talk about, where you can, in effect, multiply that 973,000 plus exemption across family members to further mitigate tax liability on the sale or other disposition of shares in a business. There are a number of things that need to be satisfied to qualify for the capital gains exemption. It must be a Canadian controlled private corporation. At the time of disposition, all or substantially all of the fair market value of the assets of the corporation must be used in an active business in Canada, and that all or substantially all has been interpreted to mean 90% or more of the fair market value of the assets. And there's a secondary test that applies such that 50% or more of the fair market value of the assets of the corporation must also have been used in the 24-month period preceding the disposition. And when you're looking at corporate assets, you need to be aware that if there's excess income, for example, and it's being invested in stocks and bonds or whatever, that's not an active business asset, even if it's perhaps being used as security to get business loans, and nor are life insurance cash values. So often what you want to do is make sure the company is being purified on a regular basis, and that normally involves establishing a holding company and the payment of that excess profits up to the holding company, and that those funds are being used there for whatever purpose that's not considered to be an active business. And that in turn requires structuring of the shares by the individual shareholders to ensure they continue to have access to the capital gains exemption. Glenn, do you have any other thoughts
Yeah,
on this one?
Yeah, I was just going to say, Kevin, that again, the insurance advisor who's getting involved in a case can play a role here, and a lot of it's just based upon fact finding. If you're regularly getting your client's financial statements, have a look at the balance sheet. And if you see assets on the balance sheet, if it's a business that you're dealing with and you see assets that don't look like business assets, maybe it's cash values, maybe it's investment assets sitting on the balance sheet of that company. Well, that's a bit of a sign that maybe there are too many passive assets. That are possibly causing the shares of the company to be disqualified from the exemption, or maybe there's a good explanation as to why those assets are there. It raises a question. So that's I think part of your standard fact finding should be looking at the financial statements, and in particularly the balance, in particular the balance sheet here, to see if there are passive assets that need to be at least discussed or explained.
Great, thanks, Glenn. Okay, we're going to talk next about section 84.1, and Glenn and I had to do some updating because of the budget, but it's all good. And this is an area that's very important when you're dealing with family-owned businesses, because it can potentially result in tax treatment of the business owner that's different than if they sell the shares to an arm's length third party. So the rules apply where there is a sale of shares to a non-arm's length person, being children, grandchildren, and the tax consequences are particularly punitive where there's a sale of shares to a corporation controlled by a family member, for example. And this is a common type of structure to be put in place because it facilitates the purchaser using the operating company's income to fund the buyout of the parent shares on a tax effective basis. And so there's rules in place that change the tax treatment to the parent to avoid that kind of planning. And basically what 84.1 will do in these circumstances is deem the proceeds not to be a capital gain, but to be a deemed dividend. And this has two potential implications. First of all, if the parent who's selling the shares to the corporation has capital gains exemption, such as the case with John, he cannot use the exemption because there are no longer capital gains. It's just deemed dividends. And as well, dividends are taxed at a higher rate than capital gains. So as I said, it's quite punitive because you lose the exemption and the proceeds are taxed at higher rate than if it had been treated as a capital gain. This issue has been elevated over the years with requests that the government fix it to allow intergenerational transfers on a similar tax basis as sales to arm's length shareholders. And a private member bill was introduced in the House that was enacted in 2021, which remedies this problem to a certain extent for intergenerational transfers. And we'll talk about the implications of those rules. But because it was a private member bill, it was not vetted by Finance and was not the best drafted piece of legislation, and Finance opposed it being enacted and shortly announced afterwards that they plan to amend the legislation to make sure that while intergenerational transfers were permitted, there was not tax avoidance planning going on through the use of transfer of shares to children or grandchildren. So Budget 2023 includes draft legislation to amend 84.1 to achieve that goal. So let's talk about what the current rules say and then how and contrast it with the new rules. So basically the rules that are currently in effect say that for the exemption to apply, the shares being transferred have to be qualified shares of a small business corporation or shares of a family farm or fishing corporation. So that applies to a number of small businesses in Canada. The shares, the purchasing corporation, which is controlled by the children or grandchildren who are adults, the purchasing corporation needs to be controlled by those children and grandchildren. It cannot be controlled by somebody else. And also there's a proviso that says that if those shares are disposed of by the purchaser corporation within 60 months, the exemption is lost. And in effect, the parent will be caught by 84.1 and the capital gain will be converted to a dividend. So there's danger in relying on this exemption because of the 60-month rule, because it could be for totally unexpected reasons the purchaser corporation is sold and you get all these negative tax results occurring. So in looking at these rules, basically Finance wanted to ensure that there could be transfers exempt from 84.1, where it was demonstrated that there's a bona fide intergenerational transfer, which basically in their view means that the children are in fact taking over the business operations from a management perspective and from a shareholder perspective. So the new rules are designed to ensure, at least in the view of Finance, that those things are in place. So in order for the exemption from 84 to apply, this is effective as of 2024, so the current rules will continue to the end of the year. The taxpayer alone or with their spouse must control the corporation being sold, which is called the subject corporation in the tax legislation. And once again, the purchaser corporation must be controlled by one or more adult children, and children will be defined to include grandchildren, nephews and nieces, and spouses of those individuals. So it's actually a bit broader group than currently under the existing exemption. Again, the subject shares must be small business corporation shares or shares in a farm or fishing corporation. That hasn't changed. And then the rules introduce two different types of transfers. One they call the immediate business transfer, which assumes that everything will be essentially finalized within a 36-month time frame after sale, or a gradual business transfer, which can take up to 10 years to satisfy the various criteria. In terms of the criteria, and again, it's based on a 36-month test or a 10-year test, the rules specify when transfer of legal and factual control from the taxpayer to the subject to the purchaser corporation is completed. And then the transfer of economic interest, which is if the vendor retains debt or certain types of preferred shares, they have to give up that economic interest within a specified period of time. They must, within a specified time, transfer management control to the children. The children have to retain control of the business for a specific period of time. And it's also required that at least one of the children be actively involved in the business. So there's still a lot of sort of review and research that's required to see the ins and outs of these rules. But overall, it appears to be a reasonable approach in terms of meeting the twin objectives of avoiding tax aggressive planning, but supporting intergenerational transfers. But there are limitations that will need to be understood and realized as we proceed to review these rules. And this is very high level right now, but the question will be for the rest of the year is, if a business owner is interested in selling their business to their children, grandchildren, should they use the existing rules, which were introduced through the private member bill, or should they wait for implementation of the new rules? And there are pros and cons, and more, I think, will evolve as we look at these rules in more detail. The downside of the current rule is this sort of clawback of the tax benefits if there is a sale of the business, sale of the purchasing business within 60 months, which results in a clawback of tax benefits. Whereas the new rules are tougher and have a lot of additional bells and whistles that need to be satisfied, but they have thrown in a new benefit that right now, if you sell shares of certain corporations and it's payable over a period of time, you can take what's called a capital gains reserve for up to 5 years. If you fall under these new rules, you get a 10-year capital gain reserve, which allows you to spread the tax bill. But also in doing so, you open yourself up to an extended reassessment period in the event that the sale itself doesn't meet all of the qualification requirements over the 3-year or 10-year period of time. So I think the best advice is to be cautious, and clients need to seek independent tax and legal advice. They shouldn't rush out necessarily because everybody's still scrambling to figure out the rules. And there may be changes based on input provided to finance. Glenn, I know you've been looking at these rules at a high level. Do you have any other thoughts or guidance?
I don't think so, Kevin. I certainly agree with what you said, and particularly you just said don't rush out and do anything. That makes a lot of sense because right now this isn't even law yet. This is a proposal. There probably will be tweaks and changes. I think it's been a really interesting process in the sense that we had a private members bill implementing tax legislation 2 years ago. I've never seen that before, and it had a lot of flaws in it that you've identified, at least some of them. And the fact that tax legislation of this importance was passed without finance being involved is, I guess, interesting or concerning. But I think the advantage is that having passed this private members bill, it sort of spurred the government. It took a while, it took 2 years almost, but they finally gotten around to making changes that probably could have been made many, many years ago. This has been an issue that's been of concern for much longer than just the last 2 years. And maybe that Bill C-208 was enough to get finance moving on these changes, which, as you say, seem reasonable, but as you also say, the devil's in the details. So we'll see. But it's been an interesting process.
Yeah, and I'm sure, well, Glenn and I will be doing a lot more work on this, and I'm sure you'll be seeing a lot more and hearing more about this in the future.
Right.
The other area that I'm going to briefly glance on, because of the time we spent on 84.1 is the TOSI rules. We're going to mention it a couple times throughout the rest of the presentation. Basically, these, again, are punitive tax rules. They're meant to prevent income splitting, and they basically can apply to dividend income payable to family members. And if the rules apply, you're taxed at the top marginal tax rate, which is the top marginal rate of 33%. So it can be, as I said, a punitive tax result. The good thing is there's a number of exceptions for family businesses. They're listed here. One that I want to highlight is that if the business owner is at least 60, I guess I'm going to highlight too, if the business owner is at least 65 years of age and they're receiving income that's not subject to the TOSI rules, then the spouse is automatically exempted from the TOSI rules as well. So for older family of business owners, they get basically an automatic exemption if one of them is exempt. And the other one that I note is that on the death of a business owner, if that owner was exempt from TOSI because they were actively engaged in the business, then those shares have special status and they're exempt from the TOSI rules. So you don't want to redeem those shares or otherwise get rid of those shares. You want those to pass on to family members so that dividends paid on those shares will be exempt, even though those family members don't necessarily meet any of the exemptions. So that's a real high level overview. We'll be pointing out a guide that provides more rules on the TOSI rules at the end, and I'm going to turn it back to Glenn to talk about estate freezing.
Well, thank you, Kevin, and thank you in particular for talking about TOSI, because you know I hate talking about TOSI. Those rules are probably the most complicated rules I've seen in the Income Tax Act, and that's saying a lot, but good for you for covering them. And of course, Kevin has a guide, a very good guide to the TOSI rules. So you'll be talking about that later. Somebody will be talking about that part later. Estate freeze considerations. And this is probably the most common estate planning technique for family business succession. And most of you will be familiar with how it works. We'll go over just some basics with the Renco shares. Basically, we know we've got $6 million worth of shares in John's hands. We know that future capital growth on those shares will create more tax in his hands. So a simple freeze would involve John exchanging his Renco common shares for two classes of redeemable and retractable voting preference shares. So we'll get into that discussion about why we're going to have two different classes. The first class of preferred shares, remember, John has an $800,000 capital gains exemption available. He can convert some of his common shares, $800,000 worth, into a separate class of preferred shares. He can elect to trigger a capital gain on those shares, which would give him an $800,000 gain. But of course, he's exempt under the capital gains exemption rules from paying tax on that gain. But from that point forward, he's got a class of preferred shares, now $800,000 worth, that can be sold or transferred in the future with no further tax cost. His second class of preferred shares would have a redemption value of 5.2 million. That's the balance, and no cost base. Upon retirement, John can gradually redeem the preference shares, the ones that don't have the $800,000 cost base, as part of a wasting freeze. He would do that, I think, only if he needed the funds for living expenses, because when you do a wasting freeze, you're going to pay tax at dividend rates. So if he redeems $100,000 worth of preferred shares, he's paying tax on a $100,000 dividend. You'd only do that again if you needed to for personal living expenses, but after retirement, that could be the best source of it. The common shares of the corporation are, of course, now issued to selected children or to a family trust. And we'll show you a diagram and talk about the advantages of a trust in a moment. But the common shares have all of the future capital growth of the underlying business, and in that way, the related capital gains liability, everything over 6 million in our example, is transferred to the next generation. It also permits multiplication of the capital gains exemption. When we have the diagram up, I'll just discuss that a little bit more. The valuation of John's shares is key. We're going to talk about valuation in family business more than once during this webinar. We have to make sure that John's shares are valued properly. We're assuming they have been valued properly at 6 million. If, for example, he decided to take a chance and value them at 4 million, trying to give away another 2 million of growth to the children, that could have negative tax consequences if the CRA caught up to him. So we're going to recommend that the valuation be done properly, fully documented, and we're going to assume that 6 million is the magic number. So here's what it might look like. We've got Renco. We've got John owning the preferred shares of $6 million. Again, two separate classes, and he's got voting control with those shares. The family trust is going to own the common shares and reflect the future growth. The beneficiaries of the trust are going to be family members. Could be anybody, could be all of the children, their spouses, grandchildren. John and Mary themselves can be beneficiaries. It probably makes sense to do that. Just in case they decide to unwind the freeze, they can transfer shares out to themselves on a tax deferred basis. Any beneficiary can receive the shares of Renco on a tax deferred basis out of the trust. We would also recommend a holding company, a new holding company be established as a beneficiary of the trust. And it can receive dividends tax-free indirectly from Renco. So Renco can pay dividends to the family trust. The trust can allocate and pay those dividends to Holdco, properly planned and structured. Holdco receives those funds as a tax-free intercorporate dividend. So there's a lot of advantages to this structure. Flexibility, it allows John and Mary to defer the decision about who will eventually own the Renco shares. So we've got 3 children. None of them is an obvious candidate to be a business successor, although maybe Annette is the most likely of the 3. But if they establish a trust, they've got essentially a 21-year time frame to decide who, if any, of the kids is going to get the Renco shares. At the 21st anniversary, there's a deemed disposition of those shares. So that's why they've got that time frame where they have to make a decision. I mentioned the tax deferred rollout. We can do sprinkling of dividends, perhaps to the various adult beneficiaries, but the TOSI rules have to be considered in that regard, as Kevin has said. The capital gains exemption is available to potentially any beneficiary of the family trust. So let's say the shares are sold in 10 years and outside the family. If there's a capital gain realized in the trust, that gain can be shared amongst the various beneficiaries of the trust, each of whom would be eligible for the capital gains exemption if the shares qualified. So many advantages to having that trust arrangement in place. Now, there's a few issues they need to be aware of. There's new trust reporting rules that apply essentially starting this year. Most trusts will have a December 31 year end, and that's when the new trust reporting rules come in. There'll be a lot more disclosure to the CRA about who the various parties to that trust might be. So there is a bit more disclosure, more transparency in terms of who's involved in the trust, and that could be perceived as a negative. The TOSI rules we've mentioned have to be considered if dividends are being paid. The corporate attribution rules, a whole separate set of rules that the tax advisor would have to look at. And again, valuation at the time of the freeze. There's probably more expense and more risk around doing estate freezes when you take into account the need for a thorough valuation when you're doing these sorts of transactions. So with that, let's talk about family shareholders agreements. And I'm going to say, we've added a trust here as a beneficiary. The trust is the trust is a shareholder. We've got family beneficiaries of the trust. As soon as you're involving another generation, I'm going to say in a family business, there's a need for a family shareholders agreement. So I think it's generally understood that arm's length arrangements should be documented. I'm not sure that families always feel the same way. Maybe they feel they'll work things out. We don't need a shareholders agreement or other documents. We don't need to specify legal rights amongst family members. But I think Kevin would agree with me. A family business, there's every reason to document, have a shareholders agreement because anything can happen. Right now, in many cases, the parents are in control. They decide what happens. But what happens when they're gone or one of them becomes disabled? Any number of things can change that dynamic, can change the control that the parents have. And if you've got an agreement to fall back on, that's a good safety valve. Family dynamics, a huge issue. Again, if mom and dad are gone, then you're left with the next generation. How well do they get along? Can they manage on their own? Again, an agreement is even if you never take it out of the drawer, it's nice to know that it's there if needed. The abilities, interest, maturity of the second and subsequent generations, those are all important aspects in terms of deciding whether any one or more kids should become shareholders. And if they do, again, we've got to document it properly and have an agreement done. And one thing I should mention here is that even if the children don't own shares today, it's the trust that owns the shares, and the children may not own shares ever, or they may not acquire shares for a long time. You can still do an agreement today, which says, if I become a shareholder at some future point, here are my rights and obligations. So that shareholders agreement can be done now, even if the second generation don't own shares directly.
And Glenn, it probably makes it easier to put it all in place at that point before the shares are distributed out. And if it's a unanimous shareholders agreement, at least in Ontario, the people receiving the shares would continue to be, if they didn't pay any consideration, would continue to be bound by that agreement.
That is correct, and that's a very good point, and that goes to the family dynamics issue. If mom and dad are in control, and everybody's getting along, and mom and dad are making most of the decisions anyway, it's much easier to get these sorts of things done rather than waiting until a later time when things have changed. You're absolutely right. Good point. So what are some issues for family agreements that may be more important or at least different in family agreements? Governance, family councils and boards. Many larger family businesses have family councils and boards and external advisors involved in various boards or family councils. Those things can be documented in an agreement. Employment and remuneration policies. If you've got a family business and maybe the policy is that family members get paid the same as an arm's length person would get of similar experience and age and abilities would get paid. So maybe you want to make sure that your children are getting paid fairly, but not getting overpaid, as it were. You can document that in the agreement. Distribution of profits. Well, maybe you've got John here with his preferred shares, and maybe he's retired, and maybe we need some rules around when he can receive dividends and in what amounts. That can be in the agreement. Share transfer restrictions and triggering events. We'll talk about a few of those. That's a big part of any shareholders agreement, of course, as is valuation, but valuation even more so in a family business. So here are some common potential triggering events that we would see, I think, in most should see in most shareholders agreements: death, disability, bankruptcy or insolvency, matrimonial dispute. You can see that in any business, by the way. It's not just a family business thing. It's also important if there's an arm's length shareholder who has a marriage breakdown, termination of employment. Those are all potential triggering events where maybe shares can or have to be sold if one of these things happens. Now, on John's death, for example, we might assume that his preference shares will be gifted to Mary. We talked about this. Probably don't need a spousal trust here, but we should talk about it. But let's assume the shares are going to be given to Mary. She'd continue to own the preference shares until her death, and she can waste those shares, draw retirement income from them. A joint second to die insurance policy to fund the buyout and the second death would be attractive if, for example, Annette wants to buy the shares. So we would have a new joint last to die policy that would provide funding for Annette to buy out her parents. If it's an employee buyout, we're probably looking at insurance just on John's life, so that on his death, there'd be funding available to allow the employees to buy his shares. And a funded buyout of the second generation shareholders is also recommended if more than one of them becomes a shareholder.
And yeah, I guess the one point I'd make here, Glenn, is the gifting of the shares on John's death would typically in Ontario at least be through a secondary will. Is that right?
That is correct, and probably the same would apply in BC. So you've got ideally, if you're in BC or Ontario and you're dealing with business owners, the wills, they would have more than one will, and the second will would cover things like shares of private corporations. So that's absolutely right. And that's another fact-finding point. So if you're in BC or you're in Ontario and you're dealing with business owners, obviously a good idea to get a copy of their wills, and hopefully they've got two, because if they've only got one will, then there's a question there as to why they've only got one. Is their lawyer not aware of the need to do two, or is the will so old that it predates the multiple will idea that's been around for 20 plus years now? So that's a fact-finding point too. You can maybe uncover some problems if you ask the right questions. So let's assume that the survivor of John and Mary has $3 million of preferred shares at the time of death, and that Renco is the owner and the beneficiary. We say 3 million. I guess we're assuming that some of these shares, half of them, have been redeemed over time as part of that wasting freeze. The insurance proceeds, of course, are paid tax-free to Renco. There's a credit to the CDA equal to the proceeds minus the policy's ACB, and a net, if it's a net as the purchaser, would buy those shares with a promissory note, and then she can pay herself a capital dividend from the insurance proceeds out of the corporation to redeem that or pay off that promissory note. A similar structure could be used to enable Annette to buy her siblings' shares, for example. So maybe the plan will be that Annette and her two siblings become shareholders, get a distribution from the trust, but then Annette, on the death of the parents, buys out her siblings. So they're getting monetized for the value of those shares, but they're not going to be shareholders going forward. Annette has free reign as the sole shareholder at that point.
And Glenn, just note there that you hopefully by then still have the 800,000 of pref shares that have full cost base. So on the death of the survivor, there's no tax on that, but they get bought out so that cash is going into the estate, which can be used to help pay any other taxes and do estate equalization if necessary with the other children.
And that's the benefit of having done that as crystallization at the time of the estate freeze. The other way to look at this, I suppose, is crystallization necessary? That's a valid question, because quite often crystallizations were done in the past on the assumption that the capital gains exemption was a temporary thing. Well, I think the capital gains exemption is now permanent. I don't think any government would have the courage to take it away. So maybe people are prepared to wait until a later time to trigger that gain. On the other side of the coin, though, that assumes the company's always going to qualify, that the shares are always going to qualify for the exemption. So maybe it is better to do the crystallization now when you know the shares are eligible. Anyway, those are the discussions that can be had with the tax advisors. On an employee purchase, it wouldn't be a whole lot different than a purchase by Annette. The employees would purchase through either individually or an individual holdco or through one or more holdcos that they own. And again, they could buy the shares using the corporate-owned insurance, corporate insurance proceeds. The one thing to be aware of here, though, is if Renco is the owner and the beneficiary of the policy and the proceeds are being used to fund an employee buyout, and well, John is indirectly funding his own buyout. So I would think there'd have to be some arrangement for the employees to share or pay all of the cost of John's insurance. So that would be part of the negotiation at the time. Valuation issues, I know I keep talking about this, but they're important. The transfer of shares is the key issue as shareholders are not dealing at arm's length. So here's what ITI 140R3 says. This is an old interpretation bulletin. It's archived, which means it's not being updated, but it probably does still represent the department's view, the CRA's view, where the deceased and the survivor to a buy-sell did not deal at arm's length. It's a question of fact whether the fair market value for the purposes of the Act 70 sub 5 will be determined with reference to the buy-sell agreement. So in other words, the CRA is saying, if you're non-arm's length parties and you agree upon a purchase price using a family shareholders agreement, we'll decide, we, the CRA, will decide for ourselves whether we think that value is appropriate. And that's why it's so important to get a proper valuation done to make it harder for the CRA to challenge the number. There's an information circular, which is still current. It's from 1989 that has a number of useful paragraphs on containing the CRA's views on the impact of shareholders agreements on valuation. So that's worth looking at. There's also a few sections in that bulletin on how to value life insurance policies, which isn't directly part of this presentation, but there's some useful information in that bulletin. Believe it or not, some stuff that the CRA publishes is helpful. So that bulletin is worth taking a look at sometime. Parents and siblings are deemed not to deal at arm's length, regardless of how strained relations might be. So brother and sister may be fighting tooth and nail, but if they have a transaction between them, they're still not at arm's length, no matter how arm's length their relationship might be. Use of independent valuators and price adjustment clauses are often recommended. So you might have a non-arm's length agreement where purchase price is determined, but there's a price adjustment clause that would adjust the price if the CRA successfully challenged it. So that's a common clause that you might see in family arrangements. The purchase price should not include the amount of insurance proceeds, and this applies to any shareholders agreement. The insurance proceeds are a funding mechanism. They're not part of long-term corporate value, and I'm saying an agreement should clearly state that so that there's no question of including the proceeds in the purchase price, because that's to be avoided. And in some cases, you'll see a reduced purchase price for buy-sell events arising on things such as bankruptcy, breach of agreement, or maybe termination of employment for cause would be another time when there could be a discounted price applicable to punish the wrongdoer, as it were. So just an example of why it's important to make sure that your valuation is done properly. Let's assume shareholder A sells shares to their daughter for 500,000 when the fair market value is equal to 800,000, let's say. And shareholder A is taxed if the CRA successfully challenges it, is taxed as if the sale price had been 800, even though the actual price was 5. The daughter's ACB would equal her actual purchase price of 500,000. So shareholder A, mom or dad, is assumed to sell for 800, but the daughter is acquiring for 500,000. The difference between those two amounts, which is 300, would be taxed again on a future disposition by the daughter. So improper valuation can lead to negative tax consequences, and that's why we keep harping on it. So we got one more slide here, and then a quiz, then a break. Matrimonial disputes, an agreement, and I think this applies equally, as I said earlier, to family and non-family agreements that could require a sale of shares where they're transferred to a spouse under a matrimonial settlement. The best protection, I think, for this to avoid litigation is a proper domestic contract with independent legal advice and full financial disclosure. And this would be true, I know it's provincial law, but it's going to be true in pretty much any province, that you have to have independent legal advice, full financial disclosure for these contracts to be enforceable. As Kevin mentioned, the unanimous shareholders agreement, and in most cases, that's what we'd be dealing with in any province, are binding on a spouse should they receive the shares for no consideration. But typically, we don't want the spouse to get those shares. And so we want to try to avoid contractually having that happen. In our fact pattern, Annette is separated. Her matrimonial issues must be addressed if she's to become a shareholder of Renco. So that's a front and center thing. It's not a what if Annette's marriage breaks down. It's already breaking down, and so it would have to be addressed in the agreement. So we're going to have a quiz, and then we'll give you 5 minutes to think about the right answer. Kevin will give you the answer as soon as he figures out what the right answer is. I'm not sure that he knows. Here's the question. Which one of the following statements is true regarding the lifetime capital gains exemption for small business shares? A, the corporation must be a farming or fishing business. B, at the time of sale, all or substantially all of the fair market value of the corporation's assets must be used in an active business carried on primarily in Canada. C, the individual must be involved in the business on a full-time basis. And D, the exemption is not available once the shareholder attains the age of 71. So that's the quiz. We'll give you the answer when we come back from our 5-minute break.
Glenn told me the proper answer was E, none of the above, but I've ascertained there is no E and have done further research, and the correct answer is B. So I know everybody got that right, and well done, and we'll move along from here.
I saw a lot of answers coming in on the chat line, and 100% of them said B.
All right.
So well done.
I just got to be able to move this forward. What's going on here? Good. Move forward 2 slides. Nope, we're good. So we've already talked about this briefly, but in the will planning for business owners, we're at least in Ontario and BC, we're talking about having 2 wills, one to govern basically non-business assets, but there may be other assets that would be through the multiple will as well that are non-business, that are not business assets. And that includes shares and debt of private corporations, personal property, or unsecured debts, basically items that financial institution does not control and require probate in order to affect a legal transfer. The other benefit associated with having a secondary will is not only avoiding the probate fees, but the will itself not being probated allows you to basically protect those assets from prying up So otherwise, a will that's probated is a public document. Anyone can do a search and find out who are beneficiaries of your estate. Another important element here that we have glanced on and is an objective of John and Mary is ensuring there is fair treatment of all the children when it's all said and done. And fair does not necessarily mean equal, although we talk about estate equalization. But when you're talking about family-owned businesses and transfers of shares, the business itself has a value, but it has liabilities attached to it. There could be tax liabilities or other risks. So you don't necessarily have to say, well, Annette's got a company now worth $6 million, so everybody else should get $6 million because Annette's got a lot of work to keep that value going in the future. But in any event, you want to ensure that there's facility to make sure that Tommy and Sally are not feeling that they've been treated unfairly. And if we have insurance to fund the buyout of shares that Annette has access to, then there'll be cash in the estate of the surviving parent, which can be used to facilitate the equalization that John and Mary want to accomplish. And that leads us into a bit more detailed discussion on life insurance. And as we noted in the facts, there is term insurance already in place on John's life. It would make sense to convert that term insurance given that we've determined there's at least a $2 million tax bill and there may be buy-sell funding requirements. And the question will be, after that's converted, who owns and who's the beneficiary? We'll talk about that. But we probably need additional insurance. And we've talked about joint last to die as being the most cost-effective way in many situations to fund it, where we're talking about either estate liabilities arising on the second death of a married couple, or if there is a buy-sell funding arrangement that will take place on the second death. And through this, when we are looking at funding needs, we need to recall that we do have an asset that has a full cost base, being the preference shares, which will not trigger a liability, although there will be potentially a buyout triggered for those shares. So turning to ownership options, there are several different ways the insurance could be set up when you have a business involved. It could be done personally, it could be done through the business, it could be done through a holding company, and we're going to talk about ways you shouldn't do it. So personal, why would you do that? It's simple. And when you have a situation where it's a family business, it may be more easy to justify because you don't have other shareholders worrying about whether the insurance is in place and whether it's being collaterally assigned and stuff like that. But less of a concern here, but still a concern. And you need to ensure ownership if its joint policy is set up properly to transfer over to the surviving spouse on a tax-free basis. If you set up the insurance in Renco and it's paying tax at small business rates, then it's cheaper to fund it through the corporate after-tax dollars versus personal after-tax dollars. But it does expose the policy to creditors. The cash value may impact the capital gains exemption availability in the future. And if the policy's if the business is sold, then you need to figure out how to get the policy out if you want to retain it. So those are all concerns and issues. So going to ownership options with personally owned insurance. So if for whatever reason John and Mary do acquire a joint second to die policy and they want to hold it personally to protect it from creditors or transfer the policy on the sale of Renco, potential sale of Renco, then there's different ways it can be set up. It could be set up with John as the sole owner and the beneficiary being the survivor, or John and Mary can be the joint owners with the survivor being the beneficiary. You want to make sure that if John is the sole owner, that it does not transfer through through a spousal trust, because there is no rollover, and and that has a secondary impact of tainting that trust that we've talked about. So those are some personal ownership considerations. Another option here that Glenn has talked about is the new corporation set up as beneficiary of the family trust, which is owned by family members. We can use that corporation to own the insurance, and the beneficiary designation depends on how you want to structure the buyout. But it allows corporate Renco to pay tax-free dividends or taxable dividends to the trust, which in turn distributes them to the corporation, and it gets a deduction for that, so it's not taxable in the trust, and the corporation itself is not taxed on that intercorporate, in effect, an intercorporate dividend. It eliminates the concerns relating to creditor protection and the other concerns that we've noted with having the policy owned in Renco. There is another issue that needs to be considered, again, in high probate provinces, Ontario and BC, Nova Scotia. There has recently been raised the issue of whether when you have corporate-owned insurance, the death benefit of that policy, so let's say you got a corporation that owns insurance on the shareholder dies, will the death benefit increase the value of the shares for probate purposes and therefore increase probate fees? There was some litigation in Ontario that did not resolve this issue, but it's one that we worry about in Ontario and BC. And again, the answer here is a secondary will that takes the shares out of the probate process. But if you have not done that or can't accomplish that, you just need to be aware that this is a potential issue depending on how courts interpret the estate taxes in those various provinces. The spousal trust issue that we talked about. So if, for example, John owns the joint second to die policy on the life of himself and Mary, and he predeceases Mary, one option would be to potentially, if there is a spouse trust set up for Mary to own the shares in Renco, to have the policy go into the trust. The trust would fund that policy on Mary's death. That triggers the tax liability with respect to those shares, and the insurance pays the taxes. Unfortunately, the Canada Revenue Agency has taken the view that ownership of insurance in a spouse trust will taint the trust. It does not meet the requirements that would allow the rollover of capital property on a tax-free basis, nor would it avoid the 21-year deemed disposition rule. So if you do this and the CRA reassesses, it would result in, for example, the shares being transferred into Renco, the gain being triggered on those shares at that time, rather than being deferred to the death of Mary. That's a disastrous tax result, triggering taxes early without the insurance being available to pay it. KLU has previously made submissions to CRA. They've not backed down on their position, so we've now gone to finance to ask for an amendment to the legislation to allow spouse and other life interest trusts to own insurance without it tainting the trust. So that's a quick discussion on insurance in relation to buy-sell and estate planning. There is another issue we want to talk about relating to insurance from a charitable gifting perspective. And I think most people on this call will be aware that one way of creating a large charitable gift on death is for an individual to acquire an insurance policy and designate a charity or several charities as beneficiary of that policy. So on their death, the insurance company pays the proceeds to the charity, and the Income Tax Act says the charity can issue a tax receipt to the deceased estate, and the deceased estate can use that tax receipt to offset taxes not only in the estate, but in the terminal return of the deceased and the immediately preceding tax return. So this is a great way to create a large tax credit on death that can be used in a variety of different tax returns to offset taxes that are otherwise payable and reduce liabilities in the estate. So you might conjecture or feel that this same strategy could be employed in a corporation where instead of the shareholder owning the policy, the corporation uses its cheaper after-tax dollars to acquire the policy and designates the charity as the beneficiary. That is a definite no-no. The CRA has indicated that there is no deduction in that situation. The gift was not made directly by the corporation, but through the beneficiary designation. And as well, there is no CDA credit that arises from the insurance proceeds because the corporation is not the beneficiary. So if you do want to use the corporation to make a large gift through insurance on the death of the shareholder, the best way to set it up is to have the corporation as the owner and beneficiary and have a corporate resolution in place that states that on the death of the shareholder, the insurance proceeds received by the corporation will be donated to XYZ charity. The charity can now issue the receipt to the corporation to offset taxes in the corporation, and as well, the corporation gets the CDA credit arising from that policy. So we just wanted you to be aware of that concern with respect to corporate gifting through insurance.
And Kevin, I just want to add quickly, although we're treating the charitable aspect here as kind of a separate topic, it's really related, I think, because charitable giving is, in this setting at least, is really part of estate planning. And so it's very common for business owners, especially quite wealthy business owners, to set up a private foundation on the second death, and as one example. And it really does become part of the whole estate plan. So I just mentioned that in passing. It's really almost like it's a combined thing with all the other planning that we're talking about.
Yeah, we didn't really get into whether John and Mary have charitable intentions or not, and the best way to deal with that, just because we didn't have enough time. But this sort of ties into the planning that you can do with your family business clients.
That's right.
Okay, when we're talking about sort of tools available that are in the planning toolkit, we can't forget about alter ego joint partner trusts. These are a special type of trust permitted under the Income Tax Act. There are several requirements. First of all, the settler of the trust and the beneficiary of the trust has to be age 65 or older. It's designed for estate planning purposes. It can be set up solely for one person or for the individual and their spouse or common law partner, and that's a joint partner trust. The benefit of these arrangements, unlike other trustee arrangements, is the transfer of property, of capital property, to these types of trusts takes place on a rollover basis. So there is no triggering of taxes, much like a spouse trust on transfer of capital property in. So the shares of Renco, for example, could go into an alter ego trust, and that would be done on a rollover basis. However, if you are transferring insurance into this type of trust, there is no rollover. And as well, as we noted, these trusts are treated similarly by the CRA as spouse trusts, and the ownership of insurance in an alter ego joint partner trust will in effect taint the trust. So that's something you don't want to do. The 21-year deemed disposition rule does not apply to alter ego joint partner trusts, and instead the disposition is deferred until an actual disposition or the death or second death of the life interest beneficiaries. Trust income is taxed at the top marginal rate if it's retained in the trust, so it's best to flow that out. So when we're looking at these types of structures, generally there's no income tax advantage other than the rollover of property in and the deferral of the 21-year deemed disposition rule. This is often used as a substitute for a will, with the extra advantage of avoidance of probate. So you don't need the secondary will. If the property is in one of these trusts, the property remains in the trust and is not subject to probate. Creditor protection, privacy, additional advantages. In BC, these tools are being used to avoid wills variation legislation, which allows family members to challenge wills more broadly than in other provinces. And already noted that we don't want to transfer insurance into these trusts or own insurance in these trusts. Another area that we need to consider with John and Mary is their powers of attorney. In this situation, depending on the circumstances, you may want to have two powers of attorney, and the spouse or children as attorney under one that governs a lot of the property, but a second power of attorney that governs business assets. And you may want to have a family member and someone with business expertise operating under that power of attorney. In this particular case, with Mary being involved in the business, that's not a big consideration. But if John and in other situations, if the spouse is not that knowledgeable, then you may want to have a business representative under that power of attorney. And then we want to talk about the children as part of the estate planning process. So we're working with John and Mary to make sure everything is working in accordance with their plan. And their plan will likely result in the children becoming quite wealthy on their death. And in some cases, they may become wealthy before that, depending on how the estate freeze transfer of shares goes in the future. So you want to make sure, John and Mary want to make sure their children's estate planning is up to date, that any family law issues are being taken care of or considered. And John, for example, John and Mary could be encouraged to encourage the children and also make it easier for them by agreeing to pay any legal or accounting costs associated with the structuring of their estates. The children themselves should be looking at their insurance needs from a long-term perspective to ensure there's sufficient liquidity for buy-sell or tax purposes. And also, to the extent children don't have wills, they should be motivated by the fact that intestacy can create very different results than having a will and results that they may not want. So going through the rules of intestacy with them and highlighting the issues and concerns would be helpful. So the last thing I want to talk about before turning it back to Glenn is coordination. So you may have powers of attorney, you may have wills, you may have trusts, alter ego, joint partner, you may have shareholder agreements. There's different people involved in drafting, reviewing, integrating with insurance that's in place. So it really is a joint project between all of the clients, professional advisors, to make sure that when it's all said and done, it accomplishes what the clients expect to accomplish, and that it's stress test and to take into account different events that may occur after the plan is put in place, so that there's flexibility to deal with that. And Glenn, I'm going to turn it over to Glenn because he's going to talk about some cases that demonstrate the need for a coordinated approach between all of the arrangements to avoid litigation and unintended effects. Over to you, Glenn.
Thank you, Kevin. And yeah, you're absolutely right. A coordinated approach is necessary. Too often we don't see it. But in cases like the two I'm about to discuss, we can at least learn from other people's mistakes, not our own. But hopefully it shows you what can go wrong and maybe will help you with ways to avoid similar things happening in the future. First case goes back 15 years now to Fry and Fry Estate, which is an Ontario Court of Appeal case. In this situation, a shareholder, Cam, died and left his shares of the family corporation to his sister, Cheryl. There were 4 siblings all together. The transfer to Cheryl in Cam's will was in contravention of the shareholders agreement, which provided, among other things, that the siblings were to always remain as equal shareholders. Well, there's maybe problem number one. Depending on the nature of the business or the nature of the corporation, it might not make practical sense for the siblings to always be equal, but that's what the agreement said. On the purported gift to Cheryl, the other siblings objected and brought legal action to prevent the transfer. They said, well, there's a shareholders agreement. Cam can't do this. It's not allowed. And the lower court found for the other siblings and said, yeah, Cheryl's gift, the gift to Cheryl, was null and void because it was in contravention of the agreement. However, it went to the Court of Appeal and they overturned the decision. The Court of Appeal said contractual obligations, such as a shareholders agreement, do not constrain a person's ability to bequeath property. So even though Cam had a contractual obligation, it didn't prevent him from trying to gift the shares to his sister. The essence of this decision was that the gift was valid even though it contravened the agreement. And so the remedy for the surviving shareholders was to sue for breach of contract. The remedy was not preventing the gift, it was to sue because there was a breach of contract. This, of course, was an awkward result. The whole thing was awkward. And basically the shares were left in a deadlock kind of situation. Don't really know what happened after this decision, but I suspect because there was nothing that could really happen without an agreement, I suspect the four siblings or the three surviving siblings came to some arrangement to get rid of the deadlock. Some sort of a settlement, I'm sure, happened. A similar result could be avoided by having a unanimous shareholders agreement that requires the sale of shares that are transferred in contravention of the agreement. This agreement did not have a clause like that. Most shareholders agreements do. If there's a transfer of shares in contravention of the agreement, normally the agreement should say they have to be sold to the other shareholders, presumably. So that was our way, at least, of avoiding the problem with the Fry case. Now, this next case is more recent. It comes from BC, where funny things always happen under the wills variation legislation. That's quite entertaining sometimes, although maybe not for the litigants. In this case, we had a deceased shareholder, Mr. Simpson. He owned half the shares of a private corporation. The other half of the shares were owned by an arm's length non-family member. Nonetheless, despite the fact that there was an agreement requiring his shares to be sold, his will provided for the shares to be gifted to his two children from a previous marriage. And the balance of the estate was left to his second wife, Miss Sasti. So the price was to be of the sale to this other shareholder was to be the fair market value of the shares, less any proceeds payable under the life insurance policies the shareholders were required to obtain. Mr. Simpson's policy was payable to Ms. Sasti. So again, the agreement said the price payable by the surviving shareholder equals the fair market value of the policy less any insurance Mr. Simpson had obtained under the agreement. That's a bit unusual. I'll circle back on that point in a couple of minutes. The gift of the shares to the children could not be completed because of the terms of the shareholders agreement. So Ms. Zasti initially received the residue of the estate plus the insurance proceeds payable to her and the buyout price from the surviving shareholder. Upon application of the children, the lower court held that the deceased intended for the children to get fair market value attributable to the shares, the full fair market value, not the net amount after insurance, and rectified the will accordingly under the BC legislation. It then went to the Court of Appeal, who said the lower court went too far. The court said rectification aligns the will with what the will maker intended to do and not what, with the benefit of hindsight, the will maker should have intended to do. So what that means is that the children were awarded the amount payable under the buyout clause in the agreement, which was the shares fair market value less the amount of insurance. So that was a reduced entitlement to the children on the basis of the BC Court of Appeal decision. So a curious fact pattern, to say the least. So let's talk about that for a second. This case was decided under the BC legislation and might be decided differently in other provinces. I think that's true. There may be a trend, one I'm not necessarily in favor of, but I think there may be a trend across the country for greater judicial overview of wills and rectification of wills. I'm not sure I want a judge to decide whether my will was appropriate or not, but that seems to be what is being said here. Beyond the actual legal issues of the case, the insurance arrangement, which was not part of the litigation really, was unusual. What each shareholder was acquired, what the agreement said was that each shareholder was to insure himself and name the beneficiary of his choice. So Mr. Simpson, in accordance with the agreement, had insured himself with his second wife, Ms. Zasti, as the beneficiary. And so the proceeds payable under the agreement were netted against that amount. So that's pretty unusual. With a couple of questions arise from tax and legal, commercial questions arise. Would the CRA treat the insurance proceeds as proceeds of disposition for tax purposes? The amount of insurance essentially reduced what the surviving shareholder had to pay for the shares. Is that a non-arm's length type of arrangement that the CRA could challenge? Maybe if they read this case, they might go back and have a look at that. Second, the commercial considerations. If you've got an arrangement that relies upon your fellow shareholder insuring himself, well, how do you know that he's actually doing that? There was really no protection for each other under this sort of arrangement. Having said that, it did seem to work out because Mr. Simpson had acquired the policy as he was required to do, but it's really not the recommended approach. Of course, the recommended approach is for typically the corporation to own the insurance on both lives. They can both oversee what happens with those policies. This didn't provide any protection. Very strange. And the final point before I give it back to Kevin, I read somewhere in the agreement that, or in the decision, that the corporation was paying all the premiums on these personally owned policies. So that creates a whole other issue around shareholder benefits, the corporation paying for personally owned insurance. So the insurance structure here was a secondary part of the case, but maybe for us, it's a lesson on how not to do it because things can go sideways if you don't have it structured properly. So that concludes this section. I'll turn it back to Kevin for the last few slides.
Thanks, Glenn. So I'm going to cover this relatively quickly because I want to make sure we have time for questions. And sort of a footnote that Glenn and I did a series on insured buy-sell agreements last year with Advocis that went 4 hours in duration. And I'm going to cover some territory in 5 minutes, but that webinar series is still available, I understand, for people to register for. It's on the Advocis education website. If you have any questions, feel free to send a note to Christine or Maya, and they can give you more direction on that. So really what we're want to do here briefly is sort of contrast arm's length businesses, arm's length owned businesses from family businesses, and just show some of the differentials you need to recognize. First of all, it's, as Glenn said, it's much more likely you'll see a shareholders agreement when you're dealing with arm's length shareholders. Typically, they have a mandatory buyout on the death of the shareholder. That will often preclude a spousal rollover, so a deceased shareholder will not benefit from deferral on the transfer of shares to the surviving spouse, subject to limited exceptions. You often also need to plug and play other family members into these types of arrangements because the shareholder may want to do some income splitting with other family members, and that requires putting in a holding company structure, which may or may not be permitted by the shareholders agreement. And then you've got more people at the table typically because each shareholder may have their own accounting, tax, legal representation that can bog down the process and require good interpersonal skills to manage. You'll often see insurance funding. If there isn't, it's an opportunity to recommend it. Here, the discussion will be around term insurance versus permanent insurance, focusing in on the long-term needs of each shareholder and the fact that the insurance might start at as term, but better to be permanent over a period of time. And then you need to worry about variations in premium between the various shareholders and how that's funded. If it's within a business setting, you need to look at creditor protection, controlling the policy on the sale of the business, monitoring the payment of insurance premiums and policy changes. And also the agreement itself should have a provision for regular updating of the valuation of the company, which in turn should trigger a review of the insurance requirements. In selecting both the insurance and the buy-sell structure, tax rates are important because that will govern where it's most cost effective to own the insurance and what the tax results will be on the death of the shareholder. Is there a capital gains exemption available that will govern how you structure the buy-sell agreement to take advantage of that? There are ways to structure buy-sells right now that allow you to get a spouse rollover, but it's tricky. So you need to consider that, and entitlement to the capital dividend account from the insurance policy needs to be specified in the buy-sell agreement so that it goes to the right parties. Overall flexibility is key. Often we see more than one structure in an agreement or a hybrid that we'll talk about briefly that allows typically the deceased shareholder's estate to determine how the buyout is structured to maximize the tax benefits to the deceased. The types of arrangements where you use corporate-owned insurance fall into four categories: corporate purchase, which operates similarly to an individual buy-sell arrangement where the insurance is owned personally, but the corporation owns the insurance and passes it out to the individual shareholders to purchase shares. Share redemption is the corporation buying back the shares of the deceased, and that has different tax consequences. The hybrid is a combination of cross-purchase and share redemption to maximize tax benefits on death. And the so-called roll and redeem strategy is structured to allow shares to transfer to the surviving spouse. And in doing so, you can basically get the repurchase of those shares on a tax-free basis to the deceased, depending on how much insurance you have. So those high level are the various structures that you have. And in this, you can complicate it further by inserting holding companies. And that's often done, as we've discussed, to ensure creditor protection for the policies and to retain ownership of the policies on the sale of the operating company. The buy-sell structure, there are multiple levels that it can be designed at, which Glenn and I talked about in the webinars from last year. And the thing that needs to be kept in mind is if you have a structure where Holdco is the owner and OpCo is the beneficiary, there may be shareholder benefit issues, particularly if OpCo is reimbursing Holdco for the premium costs. There's a recent tax court case, Jesty and Roy, which is under appeal, where I think the total taxable benefit being assessed was in the range of $1.5 million because of the operating company paying the premiums on a Holdco-owned policy. So you want to avoid that. So that takes us through a lot of information, and this is just a recap of what we attempted to impart to you today. The complexity, increased complexity of dealing with business owners and their estate planning. You need to take into account the business issues as part of the planning, issue, option, and insurance funding arrangements. And as we've noted throughout, it requires strong coordination with the client's other professional advisors, as well as a strong dose of patience and perseverance to get through this, because it can take a while to put it in place. So that's the end of our second journey. I'll turn it back to Greg to conclude the meeting and, well, to get the quick Q&A going as well.
Wow, thanks so much, Glenn and Kevin. My head's spinning a little bit. I'm sure for many of the practitioners here, there's many questions. And I'm just sitting here thinking, wow, that 50 question test right now would be kind of cool, I guess, just to see kind of what people were able to retain and, you know, where they maybe have some weaknesses. Listen, just before we get into questions, I wanted to point out these additional technical resources that are available and would make a great addition to your library if you haven't purchased them already. And just a reminder that there's a 30% discount on the third edition of the estate planning book, which will be available until the end of April. So let's get to questions. And maybe just before we look at the questions from attendees, I'll take advantage of my moderator role here and ask the first one. I know that the estate planning process for business owners can take a long time, often 1 or more years to sort everything out. In the meantime, the owners require life insurance coverage. So how do we ensure our clients are properly protected as they undergo this lengthy planning and implementation process? Who wants to jump in?
I'm going to let Glenn take that one.
Okay, I'll take that one. I guess the main thing, it's a very good question. And the main thing I would say is we don't want everything else to hold up the underwriting process. I think, of course, as insurance advisors, what we're doing is we're proposing solutions to people that include insurance and maybe a lot of other things. That's what's taking the time. But what happens if you go through a year or even 2 years and then you find out your client's not insurable? I think it's important once you've established your bona fides with the client, and once they're committed, I guess, to the process, that is hopefully at an early stage. I think there's good reason to get them underwritten as soon as possible, because you want to make sure that if there is going to be an insurance solution, that it's a viable one for the client. So I wouldn't want the insurance applications, the underwriting, to wait until the last minute, because that could end up as a disaster.
Great. Kevin, any comment, or are we good?
Yeah, well, I totally agree. And clearly it will impact the shareholders' funding for the shareholders agreement. And there may be exploration of joint policies or other insurance options that take time to get through as well. So
yeah,
no need to delay that part of the process.
And it might even involve some term insurance being placed right away that could be converted as needed later. I suppose that's another option, because the underwriting criteria are going to, the policy will have to be issued at some point. So maybe some term insurance initially would be of benefit.
All right, terrific. Thanks for that. Appreciate it. All right, what we're going to do is turn to questions from the participants, and a number of these questions relate to slides that were up there as we went along. So let's keep that in mind sort of as we try to answer these. The first one is a fairly broad question. What can financial advisors actually do to help clients prepare their succession plan?
Well, that is a general question. And hopefully what we've done today is in furtherance of that. I mean, what can a financial advisor do? Well, obviously, your expertise is going to be necessary to get to the finish line and to get the insurance options properly explained and hopefully implemented. I think you want to get it into a position where your clients have faith in you as a business advisor, not just as a provider of insurance. And maybe what you can also do, and I think insurance advisors are probably more suited to this than other professionals, and that is coordinate things. Insurance advisors are I found the best individuals to motivate clients to act. Accountants are not particularly good at it. Lawyers are terrible at it. But I think life insurance advisors are in a good position to motivate. And so by showing your client the worst case scenario or the cost of not doing any planning, you can be in a position to motivate them. And maybe that's the most important role. So anyway, those are some initial thoughts.
So this is a related question. Thanks, Glenn, for that. Do either of you have a list of questions for clients to answer when they're beginning this process, looking at the succession plan?
There's the questionnaire, but it is mostly a hard fact kind of questionnaire. So it's gathering all the data, but clearly there is a need to open the door to a broader range of discussions. We haven't, I guess it's become easier for Glenn and I, because we've done it for so long that we kind of have a routine of questions we ask, and it gets to broader questions: is where do you want to be in 5 years, and how do you see that rolling out, and what do you think you need to do to get there? And often we have personal experiences that we can relate to them. Like we worked with someone in your situation like you, and here's how we got them from A to B, and here are the issues we had to grapple with throughout that process, and sort of give them a picture of what's been done for other clients in similar situations.
So it may not be another book, Kevin, but maybe a booklet. There we
Yes.
go. All right, very good. So let's go to a third question here. Why not a family trust for John and Mary?
Well, that was a family trust, actually, Greg. I mean,
Ah.
yeah, the trust that was used in the estate freeze, I guess you could call it a family trust. And a family trust is not an exact term. A trust, it's what it sounds like. It's a trust established for family members. And that's what that trust is. It's unique in the sense that it's part of an estate freeze, and maybe it's unique because there's a corporation that's a beneficiary of the trust, but it's really a family trust.
All right, hopefully the individual heard that. So the estate freeze slide, you had a holdco as a beneficiary of the trust. You mentioned if structured correctly, the holdco could receive tax-free corporate dividends. What is the correct structure? And does holdco need to own 10, what it says here is 10.1% of opco directly?
Yeah, okay, yeah, and that's a good that's a very good question. So essentially, what happens, I think Kevin alluded to it too a little bit later after I described this diagram. But let's say Renco declares dividends payable on its common shares. Those dividends are paid to the trust as the only common shareholder. The trust then has the ability to, or the trustees have the ability to allocate that income to one or more beneficiaries. They choose to allocate that income to the holdco. And if the holdco is a related party to Renco, which it would be, it doesn't have to own more than 10% because it's related to the other shareholders. So the Part 4 tax, which we normally have to be concerned about here, would not be an issue, and essentially Holdco would receive those dividends essentially on a tax-free basis. If Holdco, if the trust was a co-shareholder with arm's length parties, it might be a bigger issue. But Kevin, I think if all the parties are related, we're basically talking about a family-controlled enterprise, there'd be no problem getting those dividends paid on a tax-free basis to Holdco. So that's really what I'm talking about when I say properly structured. Kevin, do you want to add anything to that?
No, I think that's a good discussion.
Yeah.
So on a related note here, Glenn, maybe it's yourself, but so when doing an estate freeze, is it possible or viable to have the new preferred shares owned by a holdco to allow for future dividends paid to holdco to be taxed efficiently? I know that's clear.
Yeah, it's not necessary to have the holdco as a direct shareholder of Renco. In fact,
Okay.
there's reasons why you would want to have it as a beneficiary of the family trust. So let's just say, for the sake of example, sake of discussion, there was no family trust here, and a holding company was established instead of the family trust to hold the common shares of Renco. If we've got passive assets, insurance, other investments being paid by that holdco out of tax-free dividends from Renco, we're potentially putting ourselves offside in terms of the capital gains exemption, because we've got a company perhaps with too much passive content in it. So having the holdco as a beneficiary of the trust rather than a direct shareholder of Renco avoids that issue. Hopefully I've explained that adequately.
All right. No, well, I think for the moment, that's fantastic. Two real quick ones here, and then we're going to wrap up. Should your principal residence be placed in a secondary will?
I can take that one, Kevin, if you like. In Ontario, the answer is generally no. But for the most part, and I don't know about other provinces, well, specifically, I guess it's BC is the other one where the will would be a consideration. And again, speaking generally, real estate transfers require probate. Unless it's say a husband and wife owning jointly, there's no probate until the second death. But generally speaking, no, you can't put real estate or shouldn't put it in a secondary will.
Okay.
In Ontario,
Yep.
there is a strategy of having a corporation as bare trustee for the principal residence. And then the shares of that corporation go through a secondary will. It's being done. I'm not sure if it won't be challenged in the future, but that's a strategy that I've seen being done to accomplish that goal.
I've seen it, and I'm not 100% sure that it would work, but yes, you're quite right, Kevin. I've seen that done.
Okay, and then just lastly, Kevin, you talked about rollovers. Are they sometimes termed as a gift over by some lawyers?
No, a rollover relates to a transfer of property between parties at the adjusted cost base of the property, and therefore no gain is triggered. So when we transfer property to a spouse, you transfer property to a spouse trust through a will, or while you're alive. Let's say it's shares worth $100,000, and they have an ACB of $5. They would transfer at $5, so you don't trigger the 95,000, the 99,000, whatever gain on it. A gift over is typically used to describe a situation where you make a gift to someone in your will, and they've passed away before they predecease the testator, and the will provides that in the event of the death of that individual, their share of the estate will go to their children. That's a gift over.
Wonderful. Super. Thanks, Kevin. Appreciate that. Thanks, everyone. Thanks, Glenn. Great discussion. Thanks again for all of you participating in today's session, and enjoy the rest of the afternoon. Thank you, Glenn. Thanks, Kevin.
Everybody.
Thank you all.
Thank you.
Take care.
Thanks, everyone.
Bye, everyone.